Welcome back. I'm Pratap here. Today is 9th August 2024. In this video, let us evaluate the performance of high liquidity zones generated in our previous report. And an announcement, please, if this is your first visit to our channel, please understand we are providing complete free training on supply demand zone price action. All the training videos are available at our NeoStock YouTube channel. So from our channel homepage, click on this community tab. You will get access to this post. This post is having a YouTube playlist link that will take you to all the training videos. You just click on the link. I'm clicking on the link. Now we are into the playlist Supply Demand Zone Price Action course. Here you have all the training videos are available. And so far we have released 62 training videos. And all these videos belongs to 24 training lessons as on today. And this is the most recent lesson is lesson number 24. And you just need to scroll down to bottom of the page to access lesson number 1. So here starting from lesson 1.1, all the training lessons are available in an order. So please go through all these lessons one by one and strengthen our skills related to supply demand zone price action. I have also provided the link to our Telegram channel in this YouTube video description. So from the video description, please join in the Telegram channel. It will be helpful to you. Each time when we release a new YouTube video or any other important update, we will provide at our Telegram channel. Now let's get into the analysis of the high liquidity zones generated in our previous report. So yesterday, end of the day, we have identified 3 high liquidity zones for our today's trading point of view. Out of these 3, AARTIIND Industries, we got a very good trades. A couple of trades we got. One is a fine-tuned zone and another one is also fine-tuned zone, but it is a dynamic fine-tuned zone. So let's focus on both the trades. First, let us see what is the high liquidity zone our software identified. This is the 75 minutes high liquidity zone identified by our software. So here we have a rally candle, 2 base candle and a drop candle. This is what our software has identified. And this 75 minute zone is fine tuned with 15 minutes time frame. So here in the 15 minutes time frame, we have identified a 15 minute zone. We have a rally candle, base candle and a drop candle and follow through candles. And this within this 15 minutes area, again we fine tuned with 5 minutes time frame. Look here. We have a rally, base, drop. Rally, base, drop. This is the fine tuned 5 minute zone. But here if you observe, I have placed my entry at a type 3 proximal. You know, this is the type 1 proximal. And this is the type 2 proximal. And this is the type 3 proximal. Anywhere you can plan the trade. Suppose, type 2 proximal, let me adjust. See here, just touched the type 2 proximal and then prices came down. And many times, not always, remember not always, but many times, when it just touch the proximal line and come down drastically, many times, we get a second opportunity in the same zone. Even though it is just touched, second opportunity many times we get. But it is not guaranteed. This is the point you have to observe. So that's why you have to take the trade based on your own risk, whether to accept the trade in this zone or not, because it is technically it is a tested, but at the same time there is a strong price rejection from this zone. See the push. In such kind of situation, it might give you second opportunity. Because there is a high risk, there is a higher chances what we do to minimize the risk. We can keep, because there is enough order flow is there. See the order flow. Still even type 3 proximal, the order flow is not small. There is a very good order flow is there. There are higher chances. From here again, we may get another trade opportunity. But all these are all luck based. Luck should be in our favor, because there are higher chances this zone will be violated because it is already tested at type 2 proximal. Because at type 3 we are having enough risk, enough order flow. There is nothing wrong in planning a trade in case the prices comes up to here. This is one thing. But does it really work? I already told you, it's a luck based. But many times it will work. Still it is a luck based. But at least some guarantee. When we know when there is a guarantee, if we can confirm this is a high liquidity zone, then high liquidity zone supports multi-testing. We know that. So that's why I took the help of NeoStock supply demand zone chain. This is a AARTIIND industry supply demand zone chain. See the index number 42 here. Here we have a high liquidity zone. Actually, this is the low priority high liquidity zone. But among all the low priority high liquidity zones, this is the highest priority among all the low priorities. This is almost equivalent to high liquidity zones. The high priority high liquidity zones. The only reason why we kept under low priority high liquidity zone is because of this word possible. Otherwise we have a high liquidity zone category called TCP underscore SZ, TCP underscore DZ. Because of this possible LTF, that means it could be a high priority high liquidity zone, but doubtful. The meaning is it could be a high priority high liquidity zone, but some doubts are there for the algorithm, software algorithm, while finding. Generally what algorithm, when it is having this doubt, it will identify two zones, and one could be, out of these two, one could be high liquidity zone and one could be a normal zone. That is the reason. But actually here we have only one zone, and this zone is already tested and it gave a successful trade, and there is no doubt this can be treated as a high priority high liquidity zone. So definitely without any fears we can plan a trade. But already it consumed some orders, maybe the order flow may go a little up. So that is the reason why fine-tuned to type 3 plan the trade at type 3 proximal. Even still you can plan at type 2 itself. A little above this previous high, you can place your order. But anyway, today it went up to type 3 level. But even if you add the entry buffer just before, definitely your order will be executed. Anyway, it went up to type 3 level. See here, today market is opened at 9:15 candle, price is entered 9:15, 5 minutes candle. You may ask a question, generally 9:15 candle we will be missing the trades. Yes, that's true, but actually the trade is not on the 9:15 candle. The price is stayed here in 9:16 candle, even 9:17 candle. 9:17 candle it came out of the zone. So that means 9:15 candle it went here until 9:17 the prices. After that the prices came down. Let me show you the 1 minute time frame. See, this is the 9:15 candle. This is the 9:16 candle. Prices came. And after that, this is the 9:17 candle. From 9:17 candle, it came down. So definitely your orders would have been executed. If it is a 9:15 candle, there are higher chances your trade might be missed. But here, definitely your trades will be executed. Anyway, you are keeping your trade a little before this, or maybe type 2 proximal also you might be keeping. That possibility is also there. But whatever it is, your order would have been executed here. It is a confirmed execution. It's not a luck based. This is what 9:15 is. A 9:15 candle trade is a luck based sometimes. Sometimes it will execute, sometimes luck based, because very fast the prices came and it will come down. But not the case on the next candles. The prices came, already stayed here for some time. Next candle it came down. It opened with a gap down and again came down. And then after that it came down. It reached here. So that means sometime prices are, it consumed the orders here. And what about the target? The target is the 15-minute zone, 15 minutes demand zone. Here you have a 15 minutes demand zone. You have a drop, you have a base candle, and then you have a rally candle with a hidden body. So we have a 15-minute zone. And moreover, it is getting close to 1:7 RR. So 1:6.95 RR. That means close to 1:7 RR is there for this particular, until this 15-minute zone. And when you got the trade in this candle, you got the trade at 9:15 candle. After that, the prices came and it reached the target at 10:30 candle. So 1.5 hour you are within the trade, and in that 1.5 hour it has given a profit around 13,000 something. Let me tell you the exact values. 13,900, close to 14,000 I mean. So 13,900 rupees profit it has given as per one futures margin cost, which is 8.5% ROI, return on the investment. So excellent trade today. The morning first hour itself, the first few minutes we got the trade, and by 10:30 the trade is closed. At 10:30 candle, it closed. So let me move on to the 5 minutes time frame. At 10:40 candle, 5 minutes candle, it reached the target. Okay, this is fine. Now let me delete this. Sorry. So this is the entry, this is the exit. But during you already learned in lesson 21, dynamic zone creation. See, dynamic zone creation means it's not a new concept. Generally what we do, end of the day, after market hours, we get the data, our software displays the results, and we will fine tune the zones, and we will keep it ready for our trades on the tomorrow's trading point of view. That means yesterday we got, and today trading we have make use of our analysis. But sometimes what will happen, during the live market, new zones will be created. After that, prices will be retraced into that, and again we get a new trade opportunity. What kind of new zones? Fine-tuned new zones. Because if it is not fine-tuned, we won't take a trade. Always the rule is fine-tuned. The zone should be fine-tuned. See here, a new fine-tuned 5-minute zone is created here. See, this entire area is a 15 minutes area. What kind of 15 minutes? Fine-tuned 15 minutes area. Why we are saying this entire area is fine-tuned from here to here? Because it is inside this 75-minute zone. This is entire area is 75, high liquidity zone. Inside this high liquidity zone, we have this 15-minute zone. 15-minute zone, we have a fine-tuned 5-minute zone, which is a high liquidity zone. That's why it is supporting multiple trades. Let me drop to here. So it consumed a little above, it went and further consumed and came down, and with a huge rejection. All these are all indications there is a very strong order flow. The reason why it is strong order flow, the 5 minutes is also a high liquidity. Already 75 is high liquidity. Within that 75, this 5 minutes is also high liquidity zone. But today what happened? Market started, and after that prices were coming down, and again further went up. They reached the fine-tuned 15 minutes area. Within the fine-tuned 15 minutes area, a dynamic zone is created. Which time frame? 5-minute zone. That means this is another fine-tuned 5-minute zone, but dynamically created. Dynamically means during the live market it is created. What is the difference between this zone and this fine-tuned zone? Actually both are same. Both are fine-tuned zones only. But why we have given different names? This is already based on the end of the day data. We did analysis and we planned our trade. Dynamic zones, live market, you need to observe. If you forget your observation, you will be missing trade opportunities. That's why I specially defined this concept as a dynamic zone. But technically there is no difference between this fine-tuned zone and this fine-tuned zone. Both are fine-tuned zones. Both are inside the 15 minutes fine-tuned area. Again, the 15 minutes is inside the 75 minutes area. But the only difference is end of the day data, already this zone is available, this particular rally-based drop is available. And when you do your analysis, this zone is not there. Because this zone is created during today's live market. So during your intraday live market, you have to observe these price actions. Because you have to observe these price actions, to make you guys alert, I defined a separate topic, a lesson on this particular topic, indicating that there are times during live market, new fine-tuned zones will be created and you need to observe those fine-tuned zones. It could be a 5 minutes fine-tuned zone inside 15 minutes, or it could be a dynamic 15-minute zone inside 75. Anything will possible. But today in this example, a fine-tuned 5-minute zone, dynamic one. Dynamic means live market. That is what I meant by. In the live market, a new fine-tuned 5-minute zone is created inside already existing 15-minute zone. This 15-minute zone is a fine-tuned zone of 75 minutes high liquidity zone. This is the important point. In the lesson number 21, I have explained this concept in one of the videos in lesson number 21. Maybe 5th video or 6th video, I didn't remember exactly. But one of the videos in lesson number 21, I have explained about dynamic fine-tuned zones. So the dynamic zone concept is a very important concept. Many times we ignore this. That way we miss trade opportunities. Okay, where this zone is created? Inside the fine-tuned 15-minute zone. This 15-minute zone is already we identified after our yesterday's end of the day data. While analysis, we already identified this 15-minute zone. So that's why this is a new fine-tuned this is a new fine-tuned 5-minute zone. See, here we have a rally candle. After that, we have a base candle. After that, another medium-sized candle, but this is also part of the base. And after that, you have a ERC candle, a leg-out candle. Again, you have another drop-based drop. This you cannot consider. Why we cannot consider? Because this 5-minute zone is a dynamic one, but it is not a fine-tuned zone. See, this drop-based drop is not part of the 15-minute zone. But this rally-based drop is part of a 15-minute zone. That's why we are interested only on this dynamic zone. The 5 minutes dynamic zone, which is a fine-tuned zone. And when this zone was created today morning at 9:40 candle and 9:55 candle, there is a leg out, which is inside this 15-minute zone. But already we are in a trade. As part of the trade, our first trade, this dynamic zone is created, and after that it reached the 15 minutes target. It pushed up the prices and once again came, once again it pushed, and this time it pushed up to this dynamic zone, newly created 5 minutes dynamic zone. This is a fine-tuned zone inside the existing 15 minutes fine-tuned zone. It reached, probably if you add a small buffer, very small, maybe 10 paisa buffer is enough to accept the trade. See, after that, see, again prices, again it moved and reached up to, but there are higher chances this time prices will, the target will go more deep, because previously, see, observe the price action. It just touched the 15-minute zone. At the time we exited. Further prices moved up. It didn't reach the fine tune. It just moved up and again came. Second time, see, it went a little deep inside. There are higher chances that further deep it will go, because this time the push is from the high liquidity zone. More deep definitely it will consume. So that's why what I did inside this 15 minutes, again I fine-tuned with 5-minute zone. Definitely there are higher chances it will reach this 5-minute zone. See, from here again it reached this 5-minute zone, the fine-tune. So here you can exit so that you get more profit, just to grab more profit, extra profit, rather than you exit at the proximal. There are reasons, price actions. We are using price action. See how prices are moving. Consumed the further order and again moved up. This time from fine-tuned zone it came. So definitely it will go more deep. So here we have a fine-tuned 5-minute zone. So it reached the fine-tuned 5-minute zone. in these candles. And finally this zone is violated, further moved up, and next time it is not having good power, and finally it is violated. This is a different story. But finally this is the area it reached the target. So from here to here, this is a fine-tuned 5-minute zone to this is a fine-tuned 5-minute zone is the entry, this fine-tuned 5-minute zone is the target, and this is the profit. Maybe you might have exited earlier, that is a different story. But how much opportunity this trade has given? Maximum opportunity. See, you might not have taken a trade exactly here, a little before you would have taken. You might not have exited here, a little above you might have exited. It's not about how much profit I got or how much profit you got. It's about how much opportunity our software has given for us, the high liquidity zones. That is what we are capturing in our Excel sheet. Everybody should remember. I've been telling this point several times because new people are joining, new people are learning these concepts. So that's why again and again I'm reminding this concept. Whatever we are capturing, what is the maximum opportunity is given. Within that opportunity only we can grab our share, but not beyond that. That is what you have to understand. That's why always my calculations are from the entry point, the exact entry point, the maximum possible, and also the maximum possible target point. That is the way I calculate the profits. That is what our software is providing to us. The opportunities we are getting from these high liquidity zones. That is what you have to understand. So the second trade, short trade, it has given 11,150 rupees profit. Maybe you might have got 9,000 rupees profit, exited. Maybe I might have taken 10,000 rupees profit and exited. But what is the maximum opportunity we got from this trade is 11,150. This is the dynamic fine-tuned 5-minute supply zone. See, this is also from fine-tuned 5-minute zone only. This is also fine-tuned. But this is dynamic. Dynamic means during the live market, we got the trade opportunity within that 75 minutes high liquidity zone. So this is the way Aarti Industries has given 2 trade opportunities for us. See, both the trades together today, a maximum you got 25,000 rupees profit of, you might be getting that opportunity. And how much you captured from this is up to your risk management point of view. And also RR today it has given both the trades 15.3%. ROA you would have got from your futures trade based on one futures margin cost. I am calculating. Okay, these are the 2 successful trades from the same high liquidity zone, but at different fine-tuned 5-minute zones. Out of these 2 fine-tuned, one is a dynamic fine-tuned zone. And remaining 2 stocks, one is a Godrej Properties. This is also a 75 minutes high liquidity zone. See, here we have this is the drop candle leg in, 3 base candles and a rally candle with hidden body. And this 75 minute zone again we fine tuned with 15 minutes time frame, identified 2 15-minute zones. Here we have a rally, 2 base candles and again a rally candle with hidden body. And this is not a fine-tuned 15-minute zone. But why I have drawn this zone, I will tell you. So this is the dynamic, this is an aggressive trade, the one below, because this is not part of the 15-minute zone. So you can consider this is an aggressive trade. What kind of aggressive trade? I already explained in lesson 21, but I will explain what kind, because I explained several categories of aggressive trade, which category we will discuss. But already here we have a one fine-tuned 15-minute zone, rally, 2 base candles and a rally with pro gap also. And this 15-minute zone, again I fine-tuned with 5-minute zone. So here you have a drop candle, 3 base candles, even though it is a medium-sized candle, but still part of the base. And again with hidden body, with a pro gap. So this is a fine-tuned 5-minute zone inside the 15-minute zone. But here, this is an aggressive trade. We have a drop, base, rally. And this is the high liquidity zone. Why it is high liquidity zone? High liquidity means it could be, because without help of software we are identifying. At least 80% it could be a possible high liquidity zone because of multi-testing. Several times, see here, we have a drop base, it came and tested, and again it came and tested, and again it came very close. We can consider this is a test, and again it came and tested. Exactly at the proximal line of this fine-tuned 5-minute zone, the prices are started moving up. That means a strong order flow in this there, because this is a 5 minutes, it could be a 5 minutes high liquidity zone, and which is part of the 75 minutes high liquidity zone. We already learned the 5-minute high liquidity zone, even though it is not a fine-tuned zone, it can be considered as an aggressive trade. In lesson number 21, in aggressive trade video, I have explained several types where we can accept aggressive trades. In that, one of the type is 5 minutes high liquidity zone, which is not part of the 15-minute zone. Can be considered directly, even though it is not a fine-tuned zone. But it is inside the high liquidity zone. The 75 minutes high liquidity zone, we have this 5 minutes high liquidity zone. But there is no 15 minutes fine-tuned zone. Still we can accept this zone, because it is a high liquidity inside another higher time frame high liquidity. So that's why we can plan. We have two trade opportunities. This is one zone and this is another fine-tuned zone. But anyway, today prices did not enter into this zone. With gap up today, the prices moved. We didn't get a trade opportunity. But how I fine-tune this zone is very important for our learning point of view. And the next one is MCX, multi-commodity exchange. This is also a 75-minute zone, high liquidity zone. We have a drop candle, we have 3 base candles, and again within hidden body there is a rally candle, drop base rally. And when you go to the 15 minutes time frame, in the recent price action, after the zone creation, prices went up and again came into this zone. At the time, the 15 minutes, they created a drop base rally. So we have a 15-minute zone. And this 15-minute zone could be a high liquidity zone. Why? Because multiple times prices are reaching, going up and again coming and again going up and again getting into this zone, again moving up. Multiple times this 15-minute zone is supporting. So 75-minute zone is a high liquidity zone. 15-minute zone could be a high liquidity zone. Again fine tune this 15 minutes with 5 minutes time frame. See here we have a drop candle, you have 1, 2, 3, 4 base candles and a rally candle, and I have fine tuned this zone with 5 minutes time frame. And look into this 5 minutes. Prices already tested and again going up and again tested this zone and again moved up and again tested this zone and again moving up. Multiple times prices are entering into this zone, moving up. That means even the fine-tuned 5-minute zone is also, or it could be a high liquidity zone. The fine-tuned 5 minutes also could be a high liquidity zone. That means 5 minutes could be a high liquidity zone, 15 minutes could be a high liquidity zone, and 75-minute zone is already confirmed by our software as a high liquidity zone. So that's why in this area there is nothing wrong in planning another trade next time when prices are coming. It may give you an opportunity. See, at one point of time this zone has to be violated, the 5 minutes. Until it is violated, we can grab the opportunities. Whatever the number of times the opportunities we get, we can take. Only the last opportunity, the zone will be violated. At the time we get our stop loss will hit. But multiple opportunities we have to grab from high liquidity zones. But anyway, today what happened? Prices did not enter into this zone because with the gap up, prices moved up. The only stock we got the opportunity today is AARTIIND Industries. But did you observe today is a bullish day, right? But in a bullish day, we got short trade opportunities. That is the power of the high liquidity zone. Moreover, we got 2 trade opportunities today. Both are short opportunities. Even though the overall market is today is very, see, 250 points move we have seen today overall. But short trade it gave. Previously also several times we discussed this point. Against the market, still our high liquidity zones are giving good trade opportunities for us. And today is another good example. Hope this information will be useful to you, and this is the end of the high liquidity zone analysis. Let us all meet again in our next video. Thank you.